We are live.
We are.
Everybody hear me right? See me right? It's myself, Brandon, to kind of kick this off. Yeah, just making sure we're good to go. You guys hear us okay? See us okay? Sorry.
KKTC wants Brandon's music.
There's
British Invasion playlist. There we go.
7 minutes to the Fed, man. Who's got time for music?
I know we've got time.
I wanted to get on today though before the Fed actually announced. Like that was important to me is to come on live like before the Fed actually got started. Because it's like it's all too often like we constantly go in here and right when the Fed announcement comes out. So you got 7 minutes to go to the Fed announcement. I'm going to set a few things up here before the Fed hits. One of the first things is the advanced decline line today has been actually rather stellar throughout the course of the trading session. But if you look at this, we have this positive advanced decline line. Okay, it's a hot mic. I'll give you a hot mic. I'm going to yell at him now. So get your hot mic here. Get your hot mic right here, big guy. It's also
burning my
Chris.
mouth.
Yeah, it's also Chris in there. So I don't really care. It's a hot mic. By the way, you have no idea what actually goes on in the background. The real hot mic moment would have been like 5 minutes ago before we actually went live. So with that, the advanced decline line is dramatically positive at this point. Yet the marketplace is actually being dragged down. So what we're seeing right now in early trade, we saw this this morning. There's a rotation predominantly out of some of the big tech. Does that mean that that's going to change? I don't know. Actually, the pressure coming into Broadcom is pretty decent in here. You bring down Broadcom and things start to get fairly interesting. But what's amazing about it is at points today, we've had 90 stocks trading to the upside. And again, I'm starting here because it's like the S&P 100. It's 90 stocks trading to the upside. And yet, what do you got? Okay, you got a marketplace that's actually slightly lower. I wanted to start with that, because it's all we're doing is rotate. Do you remember that episode of Friends? The pivot episode? Did you watch Friends?
Oh, go bringing the couch up the stairs?
Yes.
Pivot.
I do that all the time. And like, I don't think anybody ever catches like half the crap I do is probably from some show that I don't even remember in like the 80s or 90s.
Right.
They had Friends on. Again, Seinfeld, it was like back to back on a Thursday. And I was in college during that. And on Thursday nights, it was dollar you call it. So people would pack the bars to watch Seinfeld and Friends. I'm not sure I was of age at that point, but I'm going with that. Anyway.
See, I would just go in Provo. We don't go to bars. We go to like ice cream, like the BYU Creamery.
Nice.
Get our carbs another way.
All right. The next thing I wanted to display before the Fed actually comes out. And again, the rate cut that's coming. And by the way, I think that, one thing we could probably agree on here is that this is easily going to be a rate cut, right? So the one thing prior to the rate cut is I don't think that the cut is going to, spark the volatility. There's going to be a statement after the cut, so the cut comes with a statement, right? Some of the changing and wording over there could be interesting. But this is going to be heavy on Jerome Powell and what his statement is going to be when he does his press conference, which is always rather entertaining. So the other aspect, Brandon, in here that really makes a difference is the expected move today. So, I was bringing this up this morning. The expected move from last night was $53. Okay. It's still 51.88. Now think about that. Just pass through all that time. You only have 2 hours left in the trading session. And there's a lot of bang, a lot of punch left in this marketplace. Unequivocally, that's one of the most important things as a trader. And we're going to talk about investment strategy. We're going to look at a lot of different aspects of here. But as a trader, like, holy crap, man, that's a big number. $52 is it's almost a 1% move, not quite there, but it's big.
Well, I think, like you and Nick on Monday morning, like you're posting the expected move for the week and like you're both commenting, hey, like in our side Telegram chat, Like it seems cheap. And like when you said that, I'm like, yeah, it seems really cheap with what's going on this week. And you're just seeing that repricing all week saying, look, we came in a little too light and now we're increasing that potential expected move for this week. And we're holding on to it right now because those options have to have some premium if we're going to get any movement after the Fed. And they're saying there's expectations that we're going to move today.
Yeah, so not only are the expectations high for today, and it makes sense that this is jacked. This is like the VIX for
Mhm.
today is like 62, but it's really elevated for tomorrow.
Yeah.
It's even more elevated for tomorrow than it is on Friday's expiration, which is of pretty critical importance. But like the whole week, we're only pricing in this $94 move, and right now we're still pricing in
Right.
$92. Wow. I
We're
mean,
3 days into it and we're
you're
still
3 days in,
expecting the
right?
same.
Yeah. So what's going on right now is like if you bought options, they're actually expanding in price. They're not decaying like you think
Yeah.
they would. So it's again, it's kind of like let's get ready to rumble kind of time in the marketplace. That is the biggest takeaway. So obviously, I'm going to switch to the S&Ps, which are already rallying a little bit into what's about to be a Fed announcement. Okay. We're going to watch, tick for tick. This is not the time to get into the economics behind it. This is just the
Mhm.
time where we're going to say like, hey, look, quarter point cut, that's all we're going to see out of this quarter point cut. As I said to you, though, I think that the interesting aspect is going to come in Jerome Powell's, discussion. Also, the Fed statement changes in the Fed statement are always, quite critical. Look at this. The S&P is literally,
Yeah.
they were just down 10 and now we're massively unchanged. So I don't know. Are you excited about a cut at this point?
The reality is
In
we just
markets.
can't digest the information right quick enough. Like so we got to let the market really tell us what the interpretation is. Did someone get the announcement early here? I don't know.
Yeah,
You
no,
did.
we're out. We're good. We're ready to
We're out.
roll here. We're up already.
Yeah.
Yep.
Don got
Yep.
it early. He went in very hard on it. Apologies, I was in the wrong link. Story of
The
my life.
the S&Ps right now, nice little bid under them. So no big surprises yet. Again, if you're kind of curious, so target rate is thrown out there. What you'll start to see is quarter point as expected. We'll start to actually see come through the PR wire right now is any change in statement. There's a statement comparison that will actually run through and under global news over here. They're pretty good at actually doing a comparison. They actually use a technology to basically sift through there and quickly kind of decipher what are the key changes in the statement. This, and I want to be clear about this is not where I personally would interpret as where the volatility is going to hit the marketplace. Like if you're looking right now and you're like, nothing happened, man. We were all expecting a 25 basis point move. Okay. No kidding. I agree with that. Okay. And that's fine. The kicker is going to come, later. And that's going to be, look at this dollar. I'm relatively surprised we're seeing sell side activity in the dollar right now. That's a fairly dramatic drop. I would
Yeah.
expect that to retrench. The reason I was picking that up is gold was just made this huge move. That's a real print. Gold made just an absolutely huge move in a short period of time, and I'm a little perplexed as to some of that activity. Other than it almost looks like you know, it's
Maybe
not a fat
misprint.
finger. It's not a fat finger mistake. It's
I
not.
mean, it could be a data issue. Like, sometimes you get those prints that aren't real prints and then wash them later, scrub them out. But
That trading, man. There's times where like I actually saw it trading down here for a little bit. It wasn't just a fat finger. So there's some little bit of movement in early on in here. That advanced decline line though, now this is exactly what I was talking about. It's pegged higher. And then don't get me wrong, like a positive advanced decline line has often corresponded to rallies in the marketplace. That is not the case and has not been the case lately. When we've seen a really dramatic and again positive advanced decline line, this has prototypically been a rotation away from tech. And that's exactly, okay, how it's kind of playing out a little bit here. There's not much of a bid. I'm just showing you into Broadcom. There's nothing really going on since that Fed announcement inside of NVIDIA. Okay, order flow is kind of just scattered, a little broken in here. You know, kind of feels a little disconnected. You do have the S&Ps, okay, ramping up. For what reason right now? As I said to you, I wouldn't have expected even this much volatility.
Yeah.
Based on, you know, predicated on what? You got nothing. So that statement, again, I'm still waiting for any, like, you know, comparison in the statement. This is the whole irony, though, of the Fed announcements. And that's, it doesn't really matter. Like, I mean, we're going to look at the statements and so forth, but the order flow has played out and will play out before we could ever interpret anything. What is interesting and where we could actually get a little bit of edge is when Jerome Powell, you know, starts talking and so forth, and the conversation piece at that point will turn to, you know, what's going on inside the S&Ps, what's going on inside of volatility. Okay, volatility can often tip us off if we're going to reverse it all. Speaking of which, this was 91 just moments ago. It dropped to 85, which is a nominal decrease of implied volatility. Okay, there's only been a very nominal decrease in implied volatility when that Fed announcement came out, which implies, literally, it's implied volatility, that they're not at all waving any all clear here. You know, so it's still fully like game on. When the implied volatility, you know, drops from 60 to 53 when there's 2 hours left to go to expiration, that doesn't mean a damn thing. Doesn't mean anything. It's going to ramp right back up. And this volatility right back here, you know, was, you know, 90, the expected move was 92. It contracted a little bit, okay? But they're still pricing in a proverbial crap load of risk over here.
I mean, essentially we're rallying because I just went in a AI Copilot, put in what's the change in language, and probably the biggest change in language is they've downgraded the economy, right? So the idea is that unemployment rate rising. We're seeing just generally that in this year, that growth is slowing. And in essence, what the market's saying is, yes, the economy's slowing. Earnings are going to be great, or no? I mean, is it, or is just the fact the dollar is getting slammed here? Silver's rallying off the lows as well. I mean, so we're just, it's interesting to see, like, and it just reflects the fact we're leaning into a negative reaction, right? And we're just seeing the snapping back to where we were maybe the end of last week.
By the way, getting fed some information. It's 11-1 vote. This was an 11-1 vote. So
Mirroring.
this part's actually interesting. Like, there was no conversation. There's no conversation at Lisa Cook. She didn't give the big middle finger to anybody, you know.
It was Helen. No, wait, that's not Mirren.
Mirren.
I know.
Helen Mirren.
Yeah, you know, Mirren over here just installed, like, what, yesterday, and literally advocated for a 50 basis point cut, which is interesting. So as you were saying a moment ago, I'm sorry, they're downgrading the economy and we're rallying.
5 things. There's 5 things in this, guys, and apologies for my little delay here. Lowering the target for the Fed funds rate, obviously, you know that. Stronger statement on the downside risk to unemployment have risen. That is a reminder going back to the Wyoming speech where he basically said, hey, we're going to downgrade employment. And then a couple weeks later, 911,000 revised on top of another 840,000 revised from previous. So that's 1.7 million phantom jobs. They said that they're going to continue to reaffirm their commitment to maximum employment and returning inflation to 2%, both virtually impossible to accomplish at this point. New text, in light of the shift in the balance of risk, we will carefully assess incoming data, be prepared to adjust if risks emerge, which basically means we'll cut 50 if we have to at some point.
You had me at 25 basis points. Boy, you really should be an economist. You read that with such depth and authority in there. I felt it, man. It was like, it was Jerome Powell-ish coming out.
You got to learn how to do this if you're going to do Jerome Powell. You got to learn how to make your hands go like this as you talk. That's very important.
He does do that a little bit.
Yeah, we're going to do that.
I don't know what the hell that means.
Don's feeling the Chris Matthews thrill.
I mean, he can't talk without the hands. It's an interesting thing.
Yeah.
You know, we used to
Well,
always
yeah,
say
I mean,
that to
don't
buddy of mine.
underestimate Powell's ability to step in it, right? But yeah, I mean, obviously that we're just rallying because we say the economy is worse than we expected it to be, that we're more in line with rate cuts than we were previously, and yeah, we may get more, but in the end of the day, this is not help earnings if the economy's slowing materially and jobs are slowing. But we're all just saying, hey, we're just gonna react positively because they're gonna cut rates and that may weaken the dollar. Maybe we can push prices a little higher here.
So here's actually worth showing you. I'm actually going to go ahead and broadcast my screen again here. Sorry, it's kind of nice to be able to, actually see you guys, so forth, but I'm going to broadcast my screen for a second. As I broadcast my screen, what's going to come up is none other than the Russell. Holy crap, the Russell exploded. Absolutely exploded over here. Like, you have to realize, like, it's a small company. Yay, they're giving away free money. It's a 1/4 point cut. Calm down there, cowboy. You ain't gonna help nobody with this crap. This is something that if we peak out to highs just a little bit further, I may actually short on an intraday basis.
There we go.
Because what's going to happen is Jerome Powell is going to be immediately, forget about what is, whatever he's going to say. He's going to be short. He's going to be curt in this particular speech. Okay, speech. He's going to be short. He's going to be curt. He's going to do this. We'll look for that one, Garrett, the hand thing. But the fact of the matter is, they're going to go after him with the Q&A. Hopefully, by the way, any person doing the Q&A is over the age of like 25. You know?
Yeah, I know. Seriously, we've gotten so young.
It's like nobody wants to go into journalism like intentionally anymore.
Yeah.
They just, yeah, no, it's because you had a background in journalism. Like, nobody intentionally goes into journalism. You just kind of fall ass backwards into that now. The only ones that are actually good in that room are probably like, the old school, like Steve Leisman, who is
he's like cudgel up to you. He's like, cozy up to the Fed chair. Now he's like cantankerous.
He's always been cozy to them. He's always been the guy who gets to announce it first. That's what he always wanted to. He gets to lead the Pledge of Allegiance.
But now he's asking like the tougher questions. He's not it's kind of interesting. He's like, feels like he has to take the dad role now.
Yeah.
He always used to remind me of Gene Munster on Apple. Like, that dude would always be like the Apple fanboy. Leisman was the Fed fanboy.
Here we go. I didn't mean to start that, but there's going to be some hard questions. One of the questions that's going to be asked, and one of the hardest questions are going to be answered, is, do you see the economy actually slipping? Is that the real reason for the 1/4 point cut? They're going to go after him heavily about the economy. It's not even so much about jobs. They're going to actually talk about the dramatic, shift in the economy. Speaking of which, the Nasdaq has completely reversed any gains over here.
Of course it did. The first move is always the wrong one.
Yeah, there's a little violence inside of trading. I like violence.
Has just dropped, and again, it's all positioning right after this announcement. Now the question is, does this move back down to like 658 and then you squeeze at 230? I mean, this is just people say, like, it's a great opportunity to trade intraday for a reason.
Yeah. So one of the things by the way, somebody was like, Louis Ruckhauser. I got a great story about Ruckhauser in a minute. I'll save that one for a minute. Because I knew that this first 30 minutes is going to be a little slow. I knew this and it's not that slow. We're actually moving around a lot, but I knew this first 30 minutes would be slow until till Jerome Powell's press conference. For those of you just joining us, there is going to be obviously a press conference that follows. I'll be very frank in saying, like, probably Garrett, Brandon, and Blake is actually going to join us in that, in probably about 50 minutes. But they're going to look at some of the statements that he's actually making. Me, I'm just going to look at the order flow. I am just a diehard about that stuff. I would rather, look at that order flow, okay, and try to be able to assess like implied volatility versus, like the Russell up. But so there's a 1/4 point, cut. He's going to come out, and we're going to do a little song and dance speech in about 20 minutes, and there's going to be a Q&A in here. The trade I was looking for, which I don't think I'm going to be able to take advantage of, is going to be here in the Russell. I was looking to short Russell, okay? But I'm going to tell you, you don't short into that much of a hole. That would just be ridiculous at this point. We're already, we're down 20 handles from where we effectively were. So I'm not going to short into the hole. But the implication is that it's going to go like you're in this Goldilocks scenario Garrett, Brandon, do you guys, one of you explain, like, take as much time as you want, explain Goldilocks, because like a lot of people don't really know what that terminology means, like Goldilocks, right? Go for it.
Well, I'll share. I mean, so, Goldilocks, the porridge isn't too hot, it's not too cold, right? So if we can navigate monetary policy, you get the 2008 smooth landing, right? We're not disrupting anything, we're not overheating and being too hot. We're not behind, so we're not too cold. We're just right. So the economy can fly along and we avoid any sort of depressionary or recessionary conditions. That is Goldilocks policy. That's a Goldilocks economy, right? Everything's just
Right.
perfect.
Yeah, and they're done hiking, but they're not panicked. Treasury issuance and liquidity is strong. And the way that traders will talk about this, it's kind of the idea of you're buying the dips and cyclicals, you're focusing on growth, you're focusing on tech, your yields drift down, long duration trades benefit. The dollar's usually a little weaker, commodities are a little bit stronger. Sometimes people will advocate for emerging markets at that point, and volatility's suppressed, which is good for the carry trades and selling options, and for all of the broader, leveraged up what the leverage hedge funds do with the basis trade and all of the big FANG stocks.
Now, with Goldilocks and everything is just right, now we start to enter into a scenario where, again, if it's me asking, Powell questions, are we seeing economic slippage is going to be one of them. And slippage basically is, it can be in jobs, it can actually be in just slower growth and so forth. And the numbers, we don't have enough data on that, but the market in an instant goes from Goldilocks, where like, oh, a cut is beautiful because you're getting lower rates, the inflation is not out of control, I just love everything, into an absolute proverbial crap fest like that. It'll snap in half because we go from Goldilocks to, oh, beep, the economy is sliding. That's why they're cutting. And, I was talking about this. This morning, and I was talking about some of the guys last night. And it's this, I saw this article and it was, big time trader. It was exactly, but
no, we're getting into bid zone for me right now. So
yeah, no, this is I wouldn't be buying anything right here, man. That Nasdaq, that hurts. Okay.
We've gone from the top of the deviation line to the bottom of the deviation line real quick. So this is a fun time. Go ahead. I'm sorry. I don't want to disturb your story.
So there was an article last night and it said, on the first cut, there's always a 15% rally and there's a 100% chance, of happening. A 15% rally in the S&Ps, okay, corresponded to the year after the first cut.
Yeah.
Immediately I looked at that and I go, what the hell are you talking about? We already cut a year ago. This was
Right.
it was cut, pause, cut, pause. And you know what the irony is? The S&Ps were up, okay? The S&Ps were up 17% 1 year after that initial cut. So he was right. Now,
but 1 year's a long time.
Backsliding.
The Fed can go to ZERP in a year and the market rallies off the ZERP. And then that's what I was thinking. I'm like, well, it's easy to erase the losses a year later. I'm not sure that's necessarily the greatest measure. But I think today the questions are going to really be about how are you balancing things, inflation versus economy. And they're going to want to know which one's more important to you. Is it combating inflation, which Powell has said a lot over the last number of years that they're having trouble making any inroads on it because of other external factors. But then we have the economy side, which they're acknowledging in the statement in the revisions from the previous that the economy is slowing. And so, again, they're going to want to know the balance. Which one's more important right now?
You didn't want to say the word tariff. I could actually hear it coming out of you. You just didn't want to say it. He was like, other factors. You mean tariffs?
No. I mean, so like, for example, like in like COVID, we really curtailed production, right? And I don't think that's really normalized. I mean, China is like in a terrible position right now. I mean, they're starving for production. And so the idea is that we just weren't producing as much stuff. It's just not as available. So prices are going up. What's the Fed going to do about that? And I don't think we fully normalized that. So prices have remained sticky and they're not doing enough on their balance sheet to really make significant inroads on that as well. But obviously I think, again, are they more fearful of weaker economy, or are they more fearful for inflation or tariffs? Because apparently they think tariffs will eventually be inflationary.
By the way, I'm going to give credit to Garrett, right, where he was talking about hitting that reversion line. We reverted momentarily. We reverted
Yeah.
back
Sure.
up, but I'm going to tell you right now, they're going to come in for another round of sell side
100%.
activity here. Yeah, there's going to be some sell side coming in here.
Yeah, but the 675 for today just went up $1.30 in about 5 minutes. So that's really all you're looking for. Just this tap into the fourth deviation line that Druckenmiller has talked about on volume weighted average price, and you try to tap that bottom and see if we revert back up to the volume weighted average price. I just want to go back to what you were talking about real quick ago about the Goldilocks stuff, because you're right. The slippage concern then becomes outright contraction. So like a massive decline in job reports, credit breaking, earnings revisions collapsing. They always get it's not the too hot part that's the problem. It's if you look at Econ Pie, which I bring up, once a week, it's basically a bar grid of the entire economy. And
don't make me do it. Don't make me do it.
I'll do it. I'll put it up. I'll do it.
Dude. Oh man, I'm going to make you share.
It'll
Okay.
be 2 seconds. This is the entire economy in a box, right? Right there. Here's all of our leading indicators and all of our lagging indicators. Our leading indicators are in contraction mode right now. We're here already, right? We're already in an environment now where if home sales go this way, yield curve spread moves this way, and now all the small business up, you're 2-3 lines away from this becoming this. And now all of a sudden we have to have a deeper conversation about.
Explain me what this and this are, though. Because explain it to me like I've never seen it before, because I've never seen it before.
So this is basically a proportional rate of change box. So basically think of it as SWOT analysis. But over here, an economy is supposed to move like this. You start in contraction. So back in 2020, you move into recovery, you move into expansion, and then a healthy economy will basically move in a circle. Pretty simple. This is what the United States economy has actually done for the last 5 years.
We haven't haven't even allowed any cycle whatsoever since the financial crisis. I've gotten into that before. Yeah.
And once we got back into contraction in 2023, we changed the definition of a recession, and then we pumped the U.S. economy full of short-term treasury bills, which increased leverage, increased credit, and drove us back into, we're literally doing this now. So a healthy economy would have been back here probably by now. And they're not going to let that happen. But we're going to continue just to watch the leading indicators, because this is problematic. The mean of coordinates, the weighted mean of coordinates, it's showing that everything is starting to move into decline, and then we'll move into contraction unless they just print a bunch of money, and then, we have a K-shaped recovery.
I'm starting to think politics plays a role in the economy over here. Starting to believe that, by the way, that is not a statement for this administration, the previous administration, or basically the last 20 years.
You have to go
every president always wants,
1993. What did Clinton say? You're telling me a bunch of bond traders are going to be the reason I don't get elected? That's the real heavy start.
Wow. Well, then he started going to an island with a trader, and that went really well for him too. By the way, I always tell that story.
Allegedly, Don.
Allegedly. Hold on, Garrett.
Real quick
Garrett,
story about this.
I got to tell you this. Yes. Okay. So obviously, we live in the Virgin Islands, and we've lived in the Virgin Islands since 2020. When COVID hit, we packed up, moved to the Virgin Islands. I'm in St. Croix, but I'm on the north side of St. Croix, and on a clear day, I have a perfect view of his island. Just a perfect view of that island. So it's the most out in the open thing on the islands. They're like, we see Bill Clinton here all the time. All the time. Like everybody on the islands knows, nobody believes anybody on the islands. It'd be like 20,000 people on St. Thomas. They're like, oh, yeah, his helicopter was right there. I've seen him here multiple times. There's still argument in here. It kills me though. I love to tell that story because I've met all these people on the island. They're like, oh yeah, I stayed up there, right? Down the street. I'm like, holy crap. I'm like, interesting. Anyway, It's the biggest. So Obama actually inherited the worst economy basically since the Great Depression. That wasn't even politics around it. Basically you couldn't go down from where he was. It was unfreaking fathomable. The man was, and people don't usually remember this too. His inauguration was basically the bottom. What did we bottom in March 9th of 2009?
Yeah.
March 9th of 2009 was the actual bottom. Obviously, the inauguration was
At
just before that.
666, by the way.
Right, at
Yep.
666. You gotta love that one. But the bottom line is, though, and I'm not even blaming politicians for this. The Fed is scared to death of the recession word right now. And I mean, literally, like it's almost like an entire generation has been damaged in markets because of that and can't let go. So they're going to keep inflating that balance sheet, though. There's no question.
But here's the thing: at the end of the day, the Fed can't expand the money supply by themselves, right? They need a willing lender and a willing borrower. And of course, the federal government's insatiable in their appetite to borrow. And if they were to engage in QE, they're kind of expanding there. Or the other thing, they buy bonds from banks, they give cash to banks. Banks then lend that money out, or that greatly expands the money supply. So at the end of the day, the Fed is not all powerful in their singular ability to be able to expand the money supply. They can't do it by themselves.
They will. They're going to start monetizing debt. They have to eventually.
Well, but that takes the government going out there borrowing, lots of money, which they currently are, right? And that's going to take also companies to borrow lots of money. Does the Fed expand their policy like they did and buy corporate bonds? But at the end of the day, I mean, that really does not cure the inflation problem at all. It only exacerbates it. But at the end of the day, that's what it requires. You need a willing borrower and a willing lender in order for Fed policy to really expand the money supply. They can increase the stock, but it takes debt expansion to increase the supply.
I'm willing to take money for free. I think it's a great program. We should bring it back. So I have a mortgage on this house.
Are you Warren Buffett? Was that your Warren Buffett?
Yeah, I took a mortgage on this house, and it was like I'm like 2.25%. 2.25% on here, and I'm like, I would borrow everything I possibly could. I actually tried to max out what I could borrow. I'm like, why would
private banking rate?
Why would I ever want to put up that cash? Be like, oh, I don't want debt. I'm like 2%. Like I'm below inflation.
Yeah.
Like there's no like I'm gonna cry one day when that's gone.
Technically, it's 6%. You're below inflation, but let's not get into that math.
2.25%, man. 2.25%. And yeah, it's wild. By the way, I'm looking at Fed Fund futures now for October and have changed dramatically, and they are now fully pricing in another 0.25 point for October. So obviously the September one, it's over, it's done with. Now we're actually looking out to October, and October is pricing at 93%. If we look out to December, there's then just skips November. We don't like it November. Then December, you're all the way down to 350, 375. So we're pricing in now 0.25 point cuts and in consecutive meetings. No, I don't say much more about that. Like I like looking at the probabilities in there. And by the way, a lot of people don't realize the probabilities that I just showed you pertain to Fed Fund futures, meaning it's a tradable, tangible market. Like I don't like probabilities that don't have, a market behind them. Like when you look at something, on the screen, who cares when somebody like votes with their hand? If they're not putting their wallet on the line, then they don't get a vote. It's critically important. That's what it is, man. We should pay to vote in the United States, just like $1. You have to pay to vote in the United States. Huh? $1 every time you vote. Anybody like that one?
Every time you vote.
Every time. Well, only if you're from Chicago, buddy. Only if you're from Chicago or Baltimore. You're from Baltimore. Like,
Yes.
A lot of crap happens there too. I mean, you have a football team, but that's about all you got going on there in Baltimore right now.
We got crabs. We got
You got crabs. That's what I want. Baltimore. We got crabs.
It's great. Got traffic.
You got crabs and a beach. I mean, we do not have a beach here in Utah, and people say, "Do you ski?" I'm like, "No, I don't ski."
They have a beach. Would you go to a beach in Baltimore?
Yeah, you go to Ocean City, Maryland. You go down to Ocean City, hon.
Ocean City.
You down HC, hon.
You're not selling me on that one. Like,
and if I go to the beach, I gotta find the surf shop. Is there a good surf shop? Is there a good surf shop in Ocean City?
Yeah, you can get a tattoo on your neck that is Chinese. They'll tell you it means something, but it'll actually be some sort of menu item that you don't know about. Surf shop, no, the better place for surf shop is probably Rehoboth, which is Delaware.
Oh yeah,
Virginia
they're
Beach has
great.
got a good one. 17th Street.
Matt, you're really selling me on Delaware and like, Maryland right now. Let me tell you, you're really selling me.
I'm not here to sell real estate. I'm trying to keep all the farmland to myself.
All right.
There
All
we
right.
go.
Oh, are you a farmer now? Is that where we're going
We're
with
getting
this?
out there, man. We started clearing the land soon. It's going to be good.
That's weird.
You'll have to consult Johnny. How do you cultivate that land?
We're going to grow some broccoli. That's what we're going to do.
All right. The S&Ps prior to now, okay, Jerome Powell have literally completely cycled.
Yes.
We were higher, we were lower, we're basically massively unchanged now once again on the trading session. Question is, okay, with that, where's the emphasis at this point? Is the implied volatility contracting? And I'm going to go into the SPX once again to look at this. So has the implied volatility contracted? So when we started the discussion here 30 minutes ago, the SPX had a $92 association with risk, $92 association with risk 2 days out. The right here, which is options that expire literally in an hour and a half, they have contracted, but marginally speaking. 53 is what the overnight one was. It's contracted a little bit to 39. This was a 60 implied volatility. It's now a 52. So the answer is nominally have the markets actually contracted in terms of risk, which the implication of that is just a really simple one. It means helmets on because the market's still effectively ready to rumble. Like at this point, and again, as expected, nothing has really happened. I think that the big one that we explained is I like to explain the Goldilocks scenario because those bears would totally have eaten her. There's no question about that. And they might do the same thing today to Jerome Powell, because it's literally like, to me, the whole question now is Goldilocks or not. Everything is going to be just right. We're just going to quarter point drop, and we're just going to keep the economy kind of chugging along with quarter point drops, okay, which is not what the administration wants. The administration wants let's drop that crap to zero, let's rock. Which is dangerous. In my opinion, it's dangerous. And again, I'm not here to disagree with Jerome Powell or the administration, whatever. Okay, I don't understand. I mean, I don't understand, the undying need, and Jerome Powell speaking right now. I don't understand the undying need to drop interest rates. Totally understand it. And it doesn't have to do with the economy. It has to do with Scotty B over at the Treasury getting his proverbial beep handed to him as he tries to actually roll debt forward. Nowhere to roll to right now.
Polymarket had a 98% chance that Jerome Powell starts today's FOMC press meeting with the words, "Good afternoon."
I mean, so I'm in the market with, with Greenspan, with Bernanke, with Yellen, Powell. Has there been a Fed chairman that has seen more reversals on his press conference than Powell? Meaning that we have the initial reaction to the statement, and then he starts speaking, and then the market.
Well, to be fair with that, the first time they started doing press conferences was actually Ben Bernanke. The only reason that people even knew who Greenspan was is because Greenspan did some side talks. This is the first time the Fed started to get paid to come out and speak.
Mm-hmm.
But Greenspan did some side talks, and that's where irrational exuberance came from.
The Fed put.
Yeah, the Fed put. So Greenspan was like, he's one of the first and more notable. I guess you can go back to like Paul Volcker and stuff too, which kind of a little bit before my time. But by the way, I definitely did not study the economy at all. Like I'm not, again, I'm not trained in it, but here's the one kicker is I have family that was traders and in business, since the 70s. And I grew up with it, which may have actually warped me even more. Like I know Paul Volcker's name because they're like, my dad would be like, hey, we put you in a CD at 17%. And this is like the 1980s. You're telling like a 6-year-old kid. And I'm like, okay, 17%. Like I still,
you know about the economy
about
on a molecular level, right? The mitochondria is the manufacturing sector of the cell, right?
The only thing that ever translated for me from what I actually studied in school and what I did in finance was all the equations in derivatives were rips, including the Black-Scholes model. Black-Scholes model is a direct rip of a heat of reaction equation. It is a heat of reaction equation. So it took a lot of physics. It took a lot of, molecular biology. I had a minor in chemistry and so forth. By the way, I don't want to offend Garrett here, but I would totally hire somebody in the hard sciences well before a Wharton trained like economist. Is that
Yeah,
terrible?
100%.
But it's like it's true.
100%.
Like in today's marketplace, because I want the people that understand, much more about the equations than I do. I don't want them to have preconceived notions. I've
Yep.
been that way for like a long time too. I'm pretty diehard about that stuff. By the way, the SPs are getting.
I don't know why you're trying to why that would offend me. I've written extensively about how I only use equations. I don't trust models. I don't trust sequence of events. I don't trust any of the algorithms. I just focus specifically on how to track it. And Brandon, you asked something. I just want to show this real quick, and then Don, I'll give you the screen back. I apologize, but you said has any Fed chair had more reversals? This was the average return, the average move of the S&P 500 when Powell spoke from 2021 through 2023. This was it was this move over and over again. Breakout 230, roll over into the end of the day. And now it seems like, okay, everybody realizes that's how it's going to be. So now we're seeing some run on things at 2 o'clock. Then we start to see some moves at 2:30. That's just kind of been the that's been the pattern. It was the Powell pattern.
Here's the big move right now.
You
Bonds
look
are
at
reverting. Yeah.
And I've always, for many, many years, like 20 plus years, look at that first 30 minutes, the opening range, right? So in this case, we have the announcement, you count the clock, 5-minute bars for the first 30, and you look at the high and the low, right? That establishes that opening range, or the range following, in this case, an announcement. Tony uses opening range for in a shorter duration, but this will be after kind of key announcements, 30 minutes, establish the high and low. When you start to break out of that range, you can start to see some more significant buying or selling a lot of times when that range is broken. And so that's what I'm kind of keying off right now. Where are we in relation to those points, and can we break them? So in this case, we're looking at the low just before, or just after the announcement.
By the way, I'm watching pretty carefully here the bond market. Things are getting all kinds of freaky. So what's going to be interesting about the bond market is I would assume that the bond market, and again, just purely my assumption, this was a huge bid prior to it because we're going into a period of cutting, yada, yada, yada. Everybody assumes, that we're going to drop interest rates. It's going to help mortgages. And the marketplace is smart enough to get ahead of that, right? So what I'm going to show you guys right now is the 10-year interest rate. It's TNX, what is that, a colon? It's not even a semicolon, it's a colon.
It kills me that they went to that.
What's the new giant dash thing that ChatGPT is hooking everybody on? What the hell is that thing even called? It's like
an
it's not
M dash.
Yeah, maybe that's what it's called. I didn't do that on here, man.
If anyone's using an dash, they're writing with ChatGPT or Claude. It's a lock. It's like the number one giveaway.
You ask, like Jeff Roth will tell you, I've been using those forever. I've been using them forever, and I use ellipse, 3 dots.
Oh yeah, I use that all the time.
Yeah, because I have run-on sentences. My whole logic is run-on.
It never ends. Consciousness. ...
So that's
holy.
Anyway, there's some big moves going on right now. It's pissed off. I like it. The interest rates. So this is the 10-year, right? In the 10-year, the 10-year sold off rather dramatically. This is the actual interest rate associated all the way back down to 4%. My assumption is this got well ahead of the curve, and we're likely to see is a little bit of a rebound in here. And what this could imply is a little bit of the curve kind of flattened out. I think we're actually going to see some steepening of the curve. And for those of you that are not familiar with that terminology, this is the longer end of the curve. This is the 10-year. If the 10-year goes up to 4.5%, and in the short, the short end of the curve is it's the short bus, the one that Garrett took to school. Yep. Just let that one out. There's the stream of consciousness, dot,
Well,
dot, dot.
I had to dangle my legs out the window. It was very tough. Very tall, too
So
tall.
they have those in Baltimore. Anyway, everybody's riding that bus there. The reality is I think that this got way ahead of itself, and we're actually going to see a little bit of steepening of the curve. One thing you got to keep in mind though, if you start to see, and here's the big question mark, if interest rates go down any more on the longer end of the curve, you're going to have an inverted yield curve, which is a definitive sign of a crap economy that's coming. And we're really, really close to that right now. I mean, the idea of an inverted yield curve is very close because, well, Garrett, what are Fed fund futures presently sitting at? Like, what did they just cut them to? We were 425, 450. Now we're what? You know?
We're 425.
Yeah.
We're down to 4, right? Yeah. So
right, we're 4.4, we're 25.
Yeah.
But the 10-year is at 4. So
Right.
now the yield curve is completely flattened. If the
Right.
yield, like if this goes lower, the 10-year goes lower, we're in an inverted yield curve and everybody's going to scream, recession. Okay. And that is why I'm talking about Goldilocks. So these are the things I stay up at night. I did wake up like 2:30 last night and was actually like thinking about this. And I constantly think about those bears totally would have eaten her. It's all crap. It's all for nothing.
I mean, what's kind of interesting with the Fed funds futures right now is that in essence, you showed already what October and December basically saying 100% chance of a quarter cut.
Right.
What we've stripped away from is the possibility of more cuts, right? So we're going a quarter point and then a quarter point. We've really taken off the table just by a few percentage points the chance of us going 50, right? So we've just really coalesced around the certainty of 25 basis point cuts in the next 2 meetings. And so then you look at it, January, again, January's come off, right? So the idea that we might get to a 3.25% rate, we had a 3% probability a week ago. Now it's basically 0. So in essence, we've kind of taken off the table the bigger cut possibilities and coalescing around the quarter points.
Yeah.
They're smacking the S&Ps here.
I still think a lot of this is going to be tied back to our reverse repo and the concerns that we had coming into this week, which was what was happening with the money markets, what's going on with the banks, the reserves, 3.2 billion, 3.2 trillion is where everything's supposed to be fine. We're moving toward that 3 trillion line. You get to that 3 trillion line, if those SOFR numbers are up, that's problematic. We could see, again, we keep going back to the repo markets and concerns about interbank lending, and we saw it with the moves on the KRE in the last 2 to 3 days. The question is, what's lurking in the repo market that we don't know about, and is there going to be some sort of dislocation between the SOFR and the Fed funds rate, which then raises concerns around collateral quality, which impacts liquidity, which takes the whole market with it. That's the risk that I'm worried about.
By the way, there's only maybe 5 people in here that know what an SOFR happens to be. And maybe me and Brandon might be like one of them. So there's 3 of us and we know what SOFR.
Let's walk you through it.
You know what? You can have the screen for a second. You can have the screen for a second. I want to make a quick point over here. So the S&P is starting to feel a little bit of heat there. And the reason they're feeling heat is Jerome Powell is taking some shots right now. In my opinion, he's taking some shots at the whole tariff thing. Slowing economy, the tariffs, the possibility of inflation, yada, yada, yada. So there's definitely shots fired over here. But it was like a momentary lapse. I want to show you something interesting about this though. Any and all of the sell side activity is in tech right now. Okay. Oh, the XLF has really come off. No, it hasn't. Thing is still up almost 1% in the day. The advanced decline line is freaking stellar still. This is a dangerous position you're in right now if you're in the S&Ps. I'm going to let you explain this in a second. Okay. Here, let me actually share my screen because I just realized right now I'm not sharing the screen while I'm talking about this. You're in a very, very, very dangerous position. And I don't care if like you think we're going to rally, you think we're going to sell up. I don't give a damn. Okay. What I'm going to tell you here is critically important. There's 72 other products on the screen that could be sold and you're already down 0.5% in the S&Ps. You can get your ass handed to you in a day like this. This is a day we can easily be down 150 S&P handles because if we get correlation to the downside, you are screwed. This is setting up for not good things. Now, The one positive side of it, we're not seeing volatility start to charge higher. So the VX has got to play a role. It's got to play a role to the upside over here. If VX doesn't play a role, then whatever, the S&Ps are just down 30. It's not going to be a big deal. The reason you're not seeing volatility play a role right now is because there's 70 products trading to the upside. If you want to know what to watch right now, I would sure as hell watch right here in the XLF. If this thing starts to sell off, it's going to get ugly today. And we are, I wouldn't say on the verge of that. There's some sell side activity. We're not seeing any bid to volatility. By the way, there's a mistick in here. If you ever get a mistick like this, you're on thinkorswim. Hold on. Oh, I'm going to fix you. I'm going to fix you just right. See, correct this bar over here. And I can actually pull it up and show everybody. Remove the bar. Oh, it's gone. Tried for the corner and missed. Now you can actually see there's no bid under the VVIX, which means nobody's rushing in right now. They're like, buy volatility. No one's buying volatility because the advanced decline line is rather stable. What we're seeing is rotate, or as Brandon and I were saying earlier, pivot. Do you know what show that's from? No? Just Garrett has no idea.
What's the question?
Pivot. Never mind.
It was a TV show in the 90s. And there's a famous scene where they said, pivot.
Oh, Friends.
He's got it. That's why he works at TheoTRADE.
just for that.
Remind me. I hate to put you on the spot here. Remind me, how old are you?
Old enough.
How old are you?
44.
Okay, so I got a couple of years on you. Not too much. I'm going to be turning the corner. You know what? In March, I'm going to be freaking 50. Holy crap. It's weird for me because I was always in thinkorswim and TD Ameritrade. I was always, by 15 years, the youngest person in the room.
Yeah.
And now it's getting weird. Well, I'm still like, one of the younger people in this room, at least.
I still think I'm the youngest for whatever reason. I'm like, wait a second. Oh, Amy, is it Amy Poehler? Like she's 54. I'm like, I thought she was 20 years older than me.
And then Gianni says something like, Gianni just said like over the hill in here. Yeah, don't worry about it, man.
Well, it's like my wife after my injury 3 weeks ago, she's like went through things you can do when you're 50, and that was not one of them.
My wife, when I actually get injured and she like realizes I'm going to be okay, she laughs her ass off every single time. She goes, "How stupid are you?" And I'm like, "Very stupid." I've tried to, as I got a little older, just the last 2 years, I promised her when I go to the island by myself that I wouldn't do the stupid things that I do. And then she made me wear the Apple Watch Ultra, because I'll go paddle out into the ocean like miles by myself. And she's like, just so you make sure that you can actually call in case you get sucked into a riptide. And I'm like, okay, I'll wear it. I was paddling like 3 miles off the coast, no watch, no nothing. Didn't tell anybody. It's good stuff.
Yeah.
Good stuff.
I took an inflatable stand-up paddleboard. Took an inflatable stand-up paddleboard out in the ocean. It was joy, but you fall off that thing, man. You feel it.
All right. So now we are seeing the advanced decline line start to come in. The product to watch is the financials. I said the financials come in, you can get your butt handed to you really, really quick. There's heavy selling going on in a couple of the tech areas. It's being led by NVIDIA and Broadcom. NVIDIA looks like it's about to take another hit. Broadcom is definitely down, but it's not the leader in the clubhouse. There's no question NVIDIA is going to be the leader in that clubhouse. Apple just took a dramatic hit in the last 2 minutes, breaking its lows. So there's good sell side going on in here right now. And I say good sell side, but the advanced decline line, I warned everybody literally 3 minutes ago, and I'm like, it's not a good setup. So the only thing you would need to turn this into a full-fledged cluster is buyers of volatility, which they're not there right now. And it's unusual to see the S&Ps where they are. You got the S&Ps down 0.6%, whatever. The Nasdaq is down 1%. Again, whatever. The volatility, though, isn't moving. So again, be careful here, because what can happen is they're going to rush the marketplace. I don't care what Jerome Powell is saying. I'm all about order flow, right? But if this is going to get dicey, and he literally walks off stage, okay? So if he walks off stage and this is going to get dicey, what's going to happen is they'll come in here and they'll rush volatility, and this will soar. All of a sudden it's down 10 cents and it'll be up 15 cents in the day, and they'll smash the S&Ps down 60, 70. And that's the risk right now is big league. Like there's big league risk. Go ahead.
And I think what you're describing there is the risk for the bulls to step in here. Because I mean, the fact the VIX isn't moving just suggests that they're comfortable with this movement.
Right.
So we're getting sell side and they're okay, right? Which means that they're not ready to step in and buy vol, which means they're not ready to step in and buy stock. Again, we could see just the market just bleed maybe even for a few days before you really see that spark, right? But the idea is that I think the way I phrase it, borrowing a term from Tom Preston learned years ago, they're delta comfortable, right? They're hedged, they're okay, and they're not ready right now to just capitulate and sell and buy protection, which means that the market just may continue to drift for a while too.
Well, right now, that line on my screen over here is unchanged in the week. So the S&Ps are literally unchanged in the week, which is exactly what Brandon was just alluding to. The S&Ps are unchanged in the week. There's not a market making firm out there that gives two craps about where we are right now. They don't care because that's basically their warm and fuzzy spot, especially coming into expiration, with a triple witch coming up. So there's no movement though on the front of volatility. In fact, now the movement is actually down. Okay, everything is going to be okay. Again, though, it's a very precarious situation. Look at the significance, though, of the rotation still going on. I mean, the Dow has actually come down. It's got a bid back under it. Okay, but the fear in a time like this, it's not the here and now. It's when Jerome Powell is done and walks off the stage and everybody goes, Panic at the Disco, and things get a little bit crazy at that point. And again, we're not by any stretch of the imagination out of the woods. Just because you saw a bid back under the market and they were down 44, now they're only down 29. You're not out of the woods, because what I just looked at a moment ago is that number, okay, it's all over the place. Volatility right now is still, it's quite chaotic. This was as high as 92 earlier. It has dropped to 78, okay? But the S&Ps are, there's some slippage going on in the overall marketplace. Risk again, surprisingly, in the SEP 17 expiration, which is today, risk when Jerome Powell started speaking was at 52%. It's at 51%. It's kind of weird. Like, I know time is moving forward and this expected move should decay a little bit, which it is, but that risk metric hasn't, let go yet. And I think it starts to let go as soon as he walks off stage, which I have no idea. And I'm gonna be honest with you guys. Like, I thought to myself earlier, I'm like, should I actually have like YouTube up? Should I be watching Jerome Powell and reading it on the side? And I was like, nope.
No.
Right? Because I don't do it myself. No, when I'm not live during one of these, like I don't really spend time like looking at it anymore. I don't care. Like, I know that sounds really weird. Like, I don't care what the Q&A is. I don't want to have a thought. I don't want that thought to like influence like a position that I'm going to take in a marketplace. I would much rather, like, I've always been like a total purist. I'd much rather like, hey, what's the volatility doing? Well, it just dropped 10 cents from a couple moments ago. It was dicey, and now it's kind of easing in, but I still don't feel warm and fuzzy right now. And the reason I don't feel warm and fuzzy is because I know the advanced decline line is really good. You just don't want to have a good advanced decline line with the S&Ps down where they are. And because that's the most vulnerable position you can be in. And I don't want to persuade anybody. Can we rally? Of course. Okay. This is fair and two-sided trade. Like, we can rally, but if we rally, you're like, oh, but still my heart, we ended up 20 today. Up 20. Okay. So that'd be like a 60-point swing from where we are. It's nothing right now. The way that the tape lines up, the risk is to the downside. The risk is to the downside right now because you have that advanced decline line that's positive, with the S&Ps already off 40 handles. There's not a worse position to be in when markets sell off than to actually see like what we kind of call dislocations during the sell-off. There's a pocket that's selling off. Ironically, the pocket is all that really matters. Here's the pocket, okay, that's selling off. There it is, okay? You can't even really like, okay, Amazon's a little bit of sell-side activity. Apple hasn't even participated. Okay, Apple sucks. Apple can't get out of its own way, but it can't even get out of the way. Can you imagine if the sell-off is down 40 and all of a sudden we kick, and start to actually hit some lower numbers in terms of advanced decline line? What's going to happen is if the advanced decline line starts coming down, it's going to kick on all of these servers that do what's called statistical arbitrage. Stat arb is, why sell one when you can sell them all? And they'll literally start to spray out and fire positions out. and they'll come after Apple. And what you have to basically do is arb individual stocks in the S&P 500 into alignment with what the S&P 500 is doing. If you looked at Apple, okay, this is your suspect right now. It's going to get the living crap beat out of it if we start to go down. Apple is still, like, I know it's not the biggest monkey on the block anymore, but it's still a $3.5 trillion company capable of absolutely decimating the S&P futures. So you got to kind of keep your head in the game over here, because what's happening, literally as I'm speaking, that was 65 just a moment ago. Now it's 55. Okay. What are they doing? Yeah, they're whacking crap out of the S&Ps. How are they doing it? There's 56 other things they can sell in here. Okay. It's over when I say it's over. Look at the financials.
And looking at the broader New York Stock Exchange, we did have more advancing than declining. We're now flipping into more declining than advancing right now. Not a lot more, but again, we're still seeing that balance, even the broader New York Stock Exchange over just the S&P 500.
Like, it's about time to drink. Okay, it's 5 o'clock somewhere. You know what? So it's so funny, because for me, when I trade, it's like on a day-to-day basis, I come in here, I'd say like 85% of the time, and I'll read markets and things are just kind of floating around and it's boring. These are the days that make sense to me. This is all that makes sense to me, because I was born into volatility. Like, literally, the first 15 years of my trading career was all hell in a handbasket. The only like downtime I think I had, we were building like thinkorswim from like 2006 to maybe 2007. Those were like the chill years, of like markets. Maybe 2005 things kind of mellowed out, but then we were building thinkorswim. That was the only like time that was not extraordinary volatility for the first 15 years of my career. Started trading in 98. So I had to go through the financial crisis as a 30 something. I don't know, that probably took off like 15 years of my life, but I went through the financial crisis, and I was running a education division of the company and called into risk management. That's really good. The guy that goes out and teaches, he's risk management now for the firm. There was some wild times, but this is the stuff that starts to make more sense to me. By the way, the US dollar ripping to the upside is kind of what I was looking for earlier today as I shorted gold. And by the way, thank you so much for the emails about gold. Your call on gold sucks. I'm okay. I have no idea how it's going to go. Okay.
I know in Ghost Prints yesterday, we went bearish Hecla.
Yeah. Nice.
HL, which is the silver company.
So gold, there's a chance that I hit a 30% gain in there today and bail. Like, we'll see. Like, everything kind of turned around a little bit. Kind of curious. Like, I'm looking at Home Depot in here too. Has Jerome Powell left the main stage yet? He's still in here? Okay.
We bailed early in March. So normally I look for a 70% gain. We clipped it at 60 yesterday because I'm like, man, do I want to like put a 60% gain at risk with the Fed tomorrow? I'm like, no. So we shut that down.
Yeah, no, you know what? I actually closed a Walmart position earlier today. I had a bullish position in Walmart that I whacked out of, and I'm glad I did, because it kind of reverted back down. But this is the kind of stuff, like, again, you're still seeing the Dow positive. You're still seeing the Russell, which told you right after I wanted to short it. Okay. I could have been somebody. I would rather have missed that trade though. Like, we were talking about it when it was like pulling back in here. I would have rather missed that trade, but it ain't over yet. It ain't over. I mean, you got an hour left to play in the period here, and things are just getting interesting right now. Look at the AD line struggling. And I'm going back over to the financials again, because they bounced. I mean, and it's not a small bounce. These are huge moves. 20-cent move in the XLF in the last 3 minutes. And the third minute isn't even over. Like, it literally traded 53.65. Okay. We're at 53, like 80. Like, again, it ain't over. The financials have to basically puke their guts up and go red on the day. If the financials go red on the day, then it's over. Okay. Then it's over. So
just tell me XLF could get to below 52 by Friday. That's all I want to know.
By the way, I got another one for you here too. The expected move on the trading session was hit. The daily expected move, and I had this one up earlier, 53.55 was the daily expected move. Okay. Was hit to a T. We basically hit the daily expected move and rebounded off of it. It's dangerous. We're likely to revert at some point here back down to it. So again, that line is unchanged in the week. That's what the S&Ps are. So for all of this, we're still unchanged. All right. So Garrett, you can share your screen, man. It's okay.
I just, I look at the whole situation right now, and I got to be a little bit worried about just how markets work. So if we're cutting rates, right, we're cutting rates down to 4%. We're going to try to juice a slowing economy. Markets should obviously celebrate, right? But the banking sector is telling you something else. So the SOFR, that's what we really need to be focusing on, right? This is every day, banks will, hedge funds, dealers, everybody, they need cash. And not really they want it, they need it. And they need to settle trades. They have to meet margin calls. They have to pay redemptions. They get this cash in the repo market. And that's basically a pawn shop. So basically, I got to hand over my treasury bonds. I can get some cash today and I'll buy them back tomorrow. The interest rate that they're using is the SOFR. That's the real cost of money on Wall Street. And Brandon, you know this because one's collateral based and one's trust based. The funds rate is completely trust based, a little bit of a handshake. The other one actually has collateral. And what we're usually looking for is for the Fed's fund rate to always be above the SOFR, because the SOFR actually has collateral and the other one does not. And the last time that we did this, where we had that inversion, was 2019, where banks don't pass through the gains of the Fed funds rate everywhere else, and then the SOFR went to 10% while the Fed funds rate was at 2%, and everything just went to hell. And that was the 29 crisis in a pretty simple way of putting it. I mean, the repo market is just an overnight lending market, but the reality is everything's done in SOFR. It's not really done in Fed funds rate anymore. I think it's like $50 billion. So when you're cutting into something like this and you're leading to this wider spread, and we can go look at the SOFR rates right now. This is last night, 4.3%. That's a red flag. So this is why people were concerned about liquidity this week. They were concerned about money leaving the banking system. They were concerned about reserves dropping to 3 trillion. They're concerned just about if you're cutting into this and now all of a sudden the uncollateralized rate is somehow lower than the collateralized rate, that might actually create some sort of mechanics that can signal that banks may stop lending or at least passing through those changes. And the fear becomes counterparty failure. So the Fed's fund rate, to me, has largely always been meaningless because the SOFR is disconnected from it. This is it's interesting to watch banks sell the way that they have, given the fact that everybody remains optimistic that by cutting these rates, all of these regional banks are now suddenly going to benefit because they had all of these longer duration bonds that will go down in yield, and that will increase the value of it, and that will improve their balance sheet. So I'm still trying to make sense of this, and I need to dig a little bit deeper into this because 2019 has been the warning from people like JP Morgan, and to see the type of selling that we are seeing, the thing that I get concerned about is just always leverage leaving the system. And that's why I'm always watching the FNGD. So this is just early innings. It's just one of these things that I look at it and I say, do people really understand the mechanisms and what the potential threats are? Because in 2019, reserves were only 1.4 trillion. Today, they're about 3.1, 3.2.
Yeah, and the thing about this is that, I mean, regional banks especially, they make their money through lending. And when the Fed raised rates to 5.25%, 5.5%, they were making a lot of income off of loans. The margins weren't fantastic. We're in kind of still an inverted yield curve, but they made it on the fact that interest rates were high. And so if all of a sudden we're now cutting rates and maybe trying to steepen the yield curve, we're still, like, we saw a pretty good rally in the notes and bonds since Jackson Hole, with the Fed kind of saying we're going to cut rates. But the interesting thing is, if they're going to start to pull back on lending and interest rates are falling, not only do you have a lack of liquidity and money expansion, right? Supply of dollars expanding as a result of it, you're also having an impingement on their earnings because they have margins and they have income. So margins weren't great, but income was great. Now all of a sudden incomes go down, margins aren't necessarily improving, and the income's going down because not only rates are coming down, but we're not lending as much. Credit conditions tighten, and that does create, again, negative pressure on the broader market and economy.
Well, again, the Fed's saying we're going to make money cheaper, and then if the SOFR continues to move higher, then everybody's saying, well, screw you, we're just going to make it more expensive.
Yeah, right.
And that's
so you can go to the discount window.
Yeah.
You always go borrow directly from the Fed and hat in hand, and
but
nobody wants to do that.
Can every region? I don't think the regionals can do that.
No, not the regionals can, but the bigger banks can.
Of course. Well, JP Morgan will be fine. That's
but with KRE though, the regional banks, this is where you really think about, okay, how are credit conditions generally speaking, right? Because they're not making it off of trading revenue and all this other stuff. But again, they're more focused on the idea of lending money. And so again, they lower rates at the yield curve steepens, they can make it on the margin to increase income. But again, if they're pulling back on lending money, which you're suggesting right now, that they might do that, and also we're cutting rates, and notes and bonds are rallying, how in the world are they going to hold up here? They're not.
Well, it was the thing in 08, you could blame subprime. Now the major collateral is U.S. Treasuries, and if the U.S. Treasuries aren't good enough, then really nothing is. So that's kind of that's the end game that the Diamond's warned about. And I mean, again, we're not in this is for many years and many miles down this road. But just looking at the way that the banks have reacted today, and again, it's just all chop. It's a lot of positioning. Blake's here.
Yeah. Well, I was thinking back
to hiding in the background.
I was thinking back to 2010.
Mm-hmm.
Bank of America offered a 5-year CD rate for 0.88%, and the 5-year Treasury was at 2.5%. So we're going to take your money and pay you 0.88, and we're going to collect 2.5% because we're going to buy Treasuries with it. I mean, is that the kind of scenario where you're suggesting right now is kind of maybe happening as a result of what we're seeing with the SOFR?
Well, the question becomes if you end up in no, because again, the SOFR is going to be that overnight.
Right. But the idea being is that banks are not offering as much return as opposed to what I can handle my treasury, the SOFR, and get paid a higher rate.
Well, really, it's more of a short-term issue, right? It's that every day that the Fed cuts while the SOFR is elevated, and you have that inverse, the divergence gets worse, and then leverage unwinds can get bigger, and then that's where you start to see, the very type of bond yields moving higher. A lot of concerns around whether or not that carry trade a basis trade can continue, and then again, what happens at the top of the S&P 500, which is the FNGD. I always point back to this, but I mean, let's go back. I think we can get all the way back to 2019 if we look at this real quick. You can see exactly what happened here. 2018, 2019. There you go. Right? It's all that unwind. This is all leverage unwinding in the Magnificent Seven. And that's when the equity market goes down and everybody goes, well, what the hell's going on? We thought we were cutting rates. No, we weren't. And then all of a sudden we turned back around and engaged in more liquidity expansion until we hit COVID. 2018, 2019, right there, May. So again, I'm just, there's so much plumbing in this stuff that it becomes it can become very ugly very quickly. So we'll remain positive though. Blake, what are you excited about?
Well, I'm excited about the fact that math is math and it works out over and over and over again. So we were talking about it. I was in the 10% club, and we just every single level just hit and hit and hit. But Brandon and I talked about this yesterday. We both said that the market, I said very specifically, and Brandon was with me on this one, that the market had probably overpriced in rate cuts. Mm-hmm. So even though we did the rate cut exactly like that showed, and even though we saw other levels, the dot plot showing that we could beat a 3.4% and 3.1% by 2028, apparently we had priced in more. One of my examples is one of my worst trades ever was trading eBay back in 2005. And they consistently beat earnings. So analysts always said, you're going to come in at 19 or 20 cents. And then they'd come in at 25. They did that over and over and over again. So here we were going to earnings. I had a position long, and it gapped down $25 because they reported 1 penny better than expectations. The
Mhm.
problem is that was 20 cents less than what's happened all the other times.
And that happens on a regular basis because, again, people are always saying, all right, well, we're going to first, they always do get talked down a little bit, right? Are we going to get into that environment where firms are going to be working with their analysts to reduce their expectations so that they beat their weekend expectations heading into Q4 and Q1?
Well, but that's my point, is that we're doing the same
Yeah.
thing here, right?
Yeah.
We have that same expectation. We price in the future, we price in all expectations, and everybody says free money. And but at what cost?
Yeah. So that you're speaking to the concept of how much of a 25 basis point cut was fully priced in, and
Oh, I think it's 100%. I think
Yeah.
I'm talking about how much of the next 3 cuts were priced in by December. And so we got our 1 cut, and that was 98% lock, right? Whether
Right.
you're using the ZQ futures or the Fed watch. But it's the December, and it's the shift. And I took shots of previous and post. And the funny thing is October declined a little bit, but December and January increased. So we're already to 3 guaranteed by January now, where we weren't earlier today. So we're pricing that in the ZQ. So we're unwinding the next month, but adding to future.
As you can see, if we go all the way out to December of 2026, there are 2%, 1.75%. What type of Mad Max world do you think we would be living in if we were down at those rate levels?
Meaning more Mad Max than we already are. So here's what the deal. It'll be Tina Turner Zombie Apocalypse combined with that, because Tina Turner has to be there. If it's going to be Mad Max, it's got to have Tina Turner back. So it's Zombie Apocalypse and Mad Max. So post-dystopian Mad Max with zombies. That's what we're talking about.
Brandon, we're talking about credibility and confidence, and Powell spoke today and talked about inflation aiming to get to 2%, even though we're clearly at 3.8% on the side of services. How confident do you feel that the forecasts are actually credible, and what do you think happens if we get inflation reaccelerating again?
Well, but I mean, let's say they can't bring inflation down, and inflation is 3%, and we see slack in the economy. What should the Fed funds rate be? Right? I mean, so Blake and I talked the other day, but what is the output gap, right? I mean, if the economy starts to turn, and we can't really, maybe we can't really do anything on inflation right now. What should the Fed funds rate be? So let's say the output gap goes to -2, which means that's going to lower, according to the Taylor rule, the Fed funds rate by 1%. So that gets you down to like 3.5% versus 4.5%, or if the output gap's +1, it would be 5%. And so a lot of it just comes down right now is that depending on your outlook for the market, right, outlook for the economy, that really should shape Fed policy, and it may overshadow any inflationary concerns, even if they're wrong. But again, I mean, if we really start to see slack, again, all of it's in services, right? That's where the inflation is. I mean, that could easily turn south fast. It's not as sticky. I mean, wages can be sticky, but I mean, I just don't see the services side being as sticky as other stuff.
Well, I think I just paid $24 for a haircut, then 27 and 30, and the price went up, but the quality went down. So
yeah, I was going to say something, but
yeah, it's pretty clear. Like, oh man, you can't jump on that crap before me.
Yeah, I just cut my own hair. Like,
that's right.
I couldn't do it for 3 weeks.
Oh yeah,
Now I can touch the top of my head.
We couldn't tell that you cut your own hair, man. Like,
we've
I was sitting here quietly. I was waiting for that one too.
He was
waiting for the haircut.
He was just holding back, waiting to get. So when you look at, we talked about the data sets and consumer sentiment and job openings and homes and all these other things, Blake, what data thresholds do you think would force the Fed to completely change its guidance or change its outlook and either turn back around and stop cuts, or just maybe even have to go the other direction?
Well, I just sent Brandon a little request. Will you pull up the Fred for St. Louis with PCE? I think this is one of them that's important to me. Yeah.
You
Give me
can,
the Fred.
can
Give me
pull
the
it up,
Fred.
man.
You can do
You
it.
I'll
can
give
pull
you.
it
You
up.
take it. You take the.
Would you like,
Oh,
would you
yeah.
like
Go ahead.
screen control?
So
We'll
I
give it
get
to
to have
anybody. We'll give it to
really.
anybody these
Oh,
days. Yeah.
that's dangerous. Yeah, I'll take it. Let me share.
This is not a good
Share.
idea. This is
Yeah,
not a good idea at all.
you got it. We're good.
We
This is
all,
what I
think
think
we
will be
would
the
all
deal.
I think we would all be really good guess who characters. You can like who has glasses and you put Don and Garrett down, and who has a beard. Everybody goes down.
Who has a crappy
Who is-
haircut?
Just me.
Your mind is quality. The Floby, it works.
You know, Brandon, yours for the price you paid is infinitely better.
Yeah, you
So-
spent a couple $100 for quality tools, and
No, I'm just saying that you paid nothing. So anyway, this is the deal. Personal consumption expenditure. We know that they like PCE better than they like CPI. So the chain price index, when people say that inflation's under control, and you go, well, let's go all the way back to the measure in 1959 and say, okay, so we've literally 10 times the cost of things. Okay, fine. But this is my bigger concern. Look at this steepness of the slope. Just because from last year it's not that much, since 2020, when we put all that money in there, we had a little blip here, but we have gone up and up and up and up. So we can go and say, okay, what are we reporting? We're reporting 125 versus a year ago, which is 120. So we're just talking about that 3%. But we're constantly seeing this go up and to the right forever. And that's what we expect. That's what inflation is. That's what Fed monetary policy will do. But until the slope calms down and gets back into like we had in the 90s to 2000, that's maintainable because it's going to be about 2 to 3% a year. This is 3%, 3.5% and higher at the absolute steepest trend that we've had. So 3.5% at an already growing rate. I think this is one of the things that I'll be paying attention to, and then watching for that and going into the delinquency rates, which is slowly ticking up. And when we look at all commercial credit cards and loans, and we look for the changes on the delinquency rates, and I'm watching for housing, which is slowly ticking up, ticking up, ticking up. And I'm also watching that on credit cards. Now, credit cards kind of faded. So we were seeing a very fast climb here. Anything above 3% should be a concern. And the bigger issue is even though we dip back down, that doesn't mean that people aren't defaulting. Doesn't mean they're not delinquent. It means that we had an increase and then we've caught up or got the, I don't know if your bank does it. I logged into my bank and it said, skip a payment, right? And if you click on that, then they give you a skip a payment, then you're not delinquent anymore because you skipped a payment. So how many people were skipping a payment here? And this is on what are we at? $1.3 trillion.
When you start skipping payments, doesn't that like, make you a delinquent?
But it's not going to be reported as a delinquent. You're just a delinquent person, just not a delinquent payer.
I go to a small private bank and they don't even report to credit agencies. I just found that out the other day. They say, oh, we don't report to the credit agencies. And I go, are you kidding? Like I could be borrowing millions and millions of dollars. He goes, there's trillions out there in all these little small private banks. And he goes, they don't report to the credit agencies. A lot of people don't know that. My bank does not report to a credit agency. Isn't that nice?
Yeah. So, and I don't know if they report to the Fed or if they have to because they're a bank. I'm not sure. Anyway, these are the ones I'm watching for, is the continuation of the slowly uptaking mortgages. And it's very slow, but it's steady. We're just slowly increasing more and more and more. It's not dramatic. If this becomes dramatic, that's going to also be at the same time, this is going to be dramatic. And again, we have $1.3 trillion in credit card debt, highest level of debt we've ever had. And we are getting delinquent on that debt.
Well, this is where the Fed can get behind, right? So the idea is that, yes, we can say prices, but go back 50 years ago, we didn't care about CPI. We cared about money supply. And so even if the Fed is attempting to expand the supply of dollars out there through credit, if at the same time we're seeing debt imploding, right? Getting written off, people are getting foreclosed on, right? They're going to bankruptcy. The idea that they can do everything they can to try to expand credit, expand the money supply through credit, but then you have the net credit mark to market. The idea that if we're seeing delinquencies and all these things start to increase, it's like we're digging a hole faster than the Fed can fill it. And that's what we call a financial crisis, right? Where we start to see a significant contraction. And that's what we're on the cusp of right now. Like Blake's showing it here with credit card delinquencies. We're hovering at a point. We just need to see a bit of a tick higher. And all of a sudden, we start to see a lot of defaults come in. And the Fed's going to have a very, very difficult time through cutting rates and even QE to fill the hole created by the debt that's imploding. In essence, we're digging a hole faster than the Fed can fill it. And then they're pushing on a string, which is another phrase we use for the Fed.
I still think that everybody gives the Fed a little too much credit, thinking that like they are the primary driver of all this. Because again, while the Fed was tightening, they were draining the Treasury general account. They did reverse repo, which is about $500 billion. China's central bank was printing the whole time. Japan was never stopped printing. But at the end of the day, the central bank only works if it can move through a system. You have to have a repo market. You have to have collateral. So then you have the commercial banks, and then you have the shadow banks, and then you have government spending, and government spending is a major driver of inflation. And then you have global flows, right? So when China eases, commodities go up. When Japanese housewives are doing the carry trade, global markets shift. Like it's all so heavily interconnected now that I think the BIS wrote about this in April. The Fed doesn't have the domestic transmission control that they had since the Great Depression, but like at least in 30 years. So everything's so hyper interconnected now. That's why so much of this feels like it's all a show, to sit here and say, well, we're trying to control things here in the United States with inflation and what's happening in the employment market. But then when the Nikkei blows up last year, the Fed has to provide accommodation to ensure that their sneeze over there doesn't become our pandemic financially.
I threw the copper chart up. I don't know how much you talked about this or if you did at all. I mean, today's that evidence that we are still, like Brandon and I talked about yesterday again, this is stagflation. I just don't see any way around it. There's no number I can find that does not show stagflation. And copper selling off everything back here and then trying to recover and dropping down on Fed day, not a coincidence, back down here. So what's going to happen if we're seeing copper drop? It tells us we have no demand. And we talked about this as well, that when government spending gets to 20%, some of that government spending is being kind of double counted into business spending because their contracts being paid for, because we know the government actually doesn't make anything. They don't do anything. They're just a cost and they spend. So it's always monetary supply, and we're going to see any real growth in the business side of GDP. And so the fact that we sold off to what I've been watching from my channel and fair price, we've eliminated any hope here. This attempted move higher, this is, for me, is we're right back to a balance. We said, this is not showing growth, and a rate cut does not price that in. One of the questions I asked yesterday, and I got some feedback later on confirming that my sentiment is on the same page as many, is do you really think a 0.25% cut and maybe another 1 or 2 by the end of the year is really going to increase hiring? Employment, because that's why they say, that's why we're doing it, is to get hiring and employment and labor. Do you really think that a business that says, okay, well, I have a loan at 7% that would cost me 1% to refinance, or get a working capital loan at 9%, but since you saved me 0.25%, I'm going to hire 2 more people at a $100,000 expense? It's not going to happen.
Right. It speaks exactly to the fact that the toolbox that they have is completely and totally useless in the reality of, are 8 people sitting in a room looking at backward looking information trying to figure out, one, is this accurate? Because again, as we've said, the CPI number is cooked beyond cooked. It doesn't even make sense how they even calculate it. When the Chapwood Index, which is a private inflation metric, these people go into cities, they buy the top 250 things that people buy every single month, and then they track it, and it's up 12% annually every year for 8 years in New York since 2017. That's inflation. Now, what's the job market look like? Is it really 4.2%, or is it underemployment, which underemployment is measured by maybe something like the Ludwig Institute would put it at 23%. Like, all of this stuff is all based on numbers that legitimately don't make a ton of sense. And I agree with you, Blake. I think that this is a stagflationary environment. I think it has been a stagflationary environment. And then the question is, how do you invest for it, but then also how do you trade that? Because people don't like that term. People don't like that
Yeah.
term, stagflation.
They think I'm being an alarmist. I'm not. I'm just telling you
No,
the data.
you're dead on. It's
Yeah.
right. Because you're living it every day.
But to me, like the trade is the fact that gold will outperform the S&P 500, right? Inflation does not inherently create value,
Correct.
right? The idea that somehow that in order to grow the economy, we have to expand the money supply is a lie. You don't have to, right? You know, the quantity theory of money, you know, Milton Friedman the whole idea is a joke. The reality is expanding the money supply, you know, devaluing our currency does not create value. And in fact, you know, if you look at the Austrian economists, they say it leads to misallocation of capital.
Yep.
And what if every dollar of additional government spending we do is actually contractionary to the economy?
Correct.
I mean, it's a very possibility that it's not for every dollar spent is a dollar of GDP. It might be for every dollar spent, we're contracting GDP by 10 cents, but we're just not recognizing the fact that we're just creating activity and not creating anything of a product, right? And so, and that's, again, that's the argument for why should they cut rates with the CPI here? It's because the output gap is negative. Right. If you don't believe that, then you're saying don't cut rates. You may need to raise them. But if you think the economy's turning and the output gap GDP, real GDP, is starting to fall, that's why you cut. And is that what the Fed's saying here? Because they cut a quarter, they're going to cut another quarter and another quarter. Yep. I mean, I don't think it's Trump pressuring them. It's just a matter of they're seeing the writing on the wall and they feel the economy is materially slowing, which is ultimately not going to be good for stocks until they get to that terminal rate that ultimately starts to expand the money supply again and we start the game over.
And that's where my concern was. I was writing about this yesterday. I went back and I looked at the 2015 CBO projections for what the U.S. national debt would be in 2025. They said 27 trillion. So they only missed it by 10 trillion. Now, if you were a roofer and your math was off that bad and you built roofs, you'd still be in prison because like that number is just so dramatically wrong. So now let's look out 10 years. Now they're saying 53.8. Let's just assume that we maintain the 7% deficit number that we have now. That actually would put us around 71 to 72 trillion. But now let's actually incorporate the idea that debt goes exponential, that every dollar that you add now creates a compounding feel. There's a legitimate case for $100 trillion in 2035. And then what does that look like? Oh, well, great. The S&P 500's at 14,000, but do we actually feel richer? And the answer is no, because we haven't enhanced productivity in any capacity at the same time.
Yeah. And that's why, I mean, you look at over the last 30 years, and again, just realize that gold does not generate a return by itself, right?
Right.
It is a negative yielding asset over time because you got to protect it, segregate it, you got to whatever, right? It does not yield anything unless you borrow it out. But the reality is the S&P 500 has underperformed or maybe equal performed gold, which means that the S&P has not increased in value for 30 years. It's only gone up in price because we've devalued the dollar that much. And so again, we're not really seeing that the purchasing power of our shares of the S&P are improving. Now it's doing better than holding on to dollars in the mattress because those have lost significant value. But the idea is that where can you put your money in a stagflation environment? I mean, gold is a place to be, right? If you believe that, we're seeing slow growth and a weaker dollar, gold, and in a correction, if the market were to drop 50%, gold will outperform the market. Right?
I think you had it exact. I think it was 658% and 658% on the nose like 2 weeks ago. 30-year performance or maybe 25-year performance of gold against the S&P. And it was also maxed completely on the fact that it was all based on money supply expansion. Yeah. So, you know, it's okay. So now you got gold and you have silver and you have some of these other metals. And Blake, you know, what are the other stagflationary concepts? Is it REITs? Is it banks? Is it pipeline systems? Like, what are the other things that can kick off a lot of cash that become long-term plays to deal with this? And let's assume that we have to get into an environment where we have to have a Volcker style setup, and maybe that's 3-4 years away from now, but interest rates do have to go to 7, 8, 9% in order to get all of this under control.
Well, and I think so. I pulled up Carry, and I've been talking about this for the last couple of weeks. So I've been waiting for this to pull back and give us a trade, and it all depends, like Brandon and I talked about yesterday, and Brandon just mentioned, whether we land. But there will become a point where the yield spreads get wide enough. If we're going up to 7 and 8 and 9%, these banks will be sitting flush with cash because they're going to borrow at the lower rates.
Right.
And so when the rates go back up, and the market drives that rate, like Garrett was talking about. Yields are driven by market participation in the bonds, not the 30-day Fed funds. It's a big rubber band, has a tendency to pull things around, but reality is it's the market's demand for bonds that change yields, and yields are what determines how banks lend and what they lend off of the yield. So if those yield spreads get wide enough, go back to 2%, 2.5%, and 3%, and we see the money going out in the market, I do like regional banks for the long term. And I like how it behaved today, right at its fair price, right at its balance for the month, dropped down, came back up, and just sitting here. So I'm looking for this to go back up. But anyone that's ever listened to me, you know what I like, and that is Costco, Kroger, and Walmart. So I'm watching for these, and look at Costco, right back up today. Kroger gapped up, came back down a little bit, but oversold at this point. And then the Wally World, I mean, these are all the ones that win because of that stagflation. This is where we're going to be concerned. This is I haven't changed. If you've been listening to me for the last year, these are the places I want to be because these are the ones that do best in a stagflation market. I would also throw defensive as an aerospace defense because government's going to continue to spend there.
Electricity, REITs, things in that area, utilities.
Yeah, utilities, but you have to time it. So utilities are fine, but I think you have to time it a little bit to get your dividend yield that you want, as well as be able to structure this right. So
was there a period, because last year for me, it was right around February and March of last year, gold was sitting around 2,100. We had just come off this sell-off where gold went from about 1,600 to 2,100 in about 3 or 4 months. And I just remember sitting back and I'm thinking, okay, this feels like the job market's invented. It feels like stagflation starting to kick in. What was the starting point for you to say, okay, this is much worse than what is being projected out there right now when it comes to inflation and the underlying employment situation?
Well, I always like to watch gold and bonds, and then a gold or a commodity, general commodities and bonds ratio. You know, and you know, this goes back to my economics background, is everything is compared to risk-free premium, right? The whole idea of comparing to what is the free trade, what is the return based compared to a bond. And so I'll just throw this on really quickly. Whoops, not Paris, but pairs. Pair ratio. And so what I'm gonna do is I'm gonna compare this pair ratio, not pairs ratio. We want the that's not the one. Sorry, it is the price ratio. Sorry about that. Not the pairs, price ratio. And I'll just show you the two that I like to use. And one is gold as an inflation hedge versus bonds. And I use the 10-year because it's closest to what we see in housing. And because they use the 7 and 10-year bonds to create mortgages. And so if I go through here, this pairs ratio, let me get rid of my money flow index. This is when I see these breaking out into an acceleration like this, while the market, you know, gold prices are going flat. We're not hedging, and yet we're creating inflation compared to returns. So comparing, oops, that's the SPY. Hang on. I changed it, but I didn't tab out of it. 1 second. So it's gonna say it looks a lot more dramatic here. If I change it to gold, there you go. So when we see this in 2020, we spiking higher, and that's compared to the risk-free premium. We went into that holding pattern, and right here, we traded down, we traded up, and this acceleration began new record highs starting in 2023. And everything since then has just gone faster and faster and faster and faster. So the risk-free premium compared to inflation hedge of gold, this is a massive change. We've doubled the risk-free premium, this is arguably at 100% inflation when compared to bonds. And that's scary. Gold to bonds, we 100% inflation hedge in there from just 2023. We went from 15 to now we're at 32 today. That to me is kind of stagflation. Now I can do the same thing and do it with general commodities. DBC is heavier weighted into oil, and this is going to be more of a demand situation. So we spiked up in 23, but look what we're doing as far as demand. We're fading. From the same 2023 breakout, we've dropped 20%. So inflation hedge 100%, 2 times as high. And yet, when we look at general commodities, DBC, which is heavy into oil, we're seeing no demand. And it's even worse with copper. So these were my signs. 2023, we just saw more and more and more signs of growth is fading, inflation's rising. And I don't know, maybe there's other ways to do it, but that was the big sign for me.
Well, so we're
Brandon,
talking
anything on
gold,
your end?
but is Bitcoin going to replace gold here? Or are we just saying Bitcoin is still a speculative asset?
I continue to argue that Bitcoin is a reflection of global liquidity, and I've shown that chart a couple of times. If you want to see it, it's
Take over. I just was really quickly showing that Bitcoin just can't get out of its own way here at 11 or 117,000. So anyway,
so
you can
this
take control.
This goes back to Michael Howell's argument of what liquidity is and the creation of capital in the global system, shadow banking, commercial banking, and the relationship. So when we hear about crypto winter, we are talking about drying up of liquidity and capital in the system. So there is the 2014-15 winter. There's the 2018-2019 winter. Here's our 2022-2023. And we've expanded up. We're now at about 190 trillion. And it's tracked very closely. Now, gold has a pretty strong relationship with this, and speculation does. But the argument is that this is kind of the proxy for it. So if capital expansion continues, we have what, $310 trillion in global debt, 180 trillion in global liquidity that is utilized to refinance that existing debt. And if debt increases by 100% every 12 to 15 years, if you just follow that, so long as it's not outlawed, Bitcoin would be pushing the $220,000 to $240,000 level with a minimum in the next 10 years.
So I think looking at that chart, we're saying that yes, it does look like gold, because again, if we're talking about liquidity, we're talking about expanding the supply of dollars, right?
Yes.
And all currencies generally, but we're specifically dollars are expanding this. So therefore they were devaluing the dollar. As a result, if Bitcoin holds its value, if gold holds its value, it should go up as well. So,
Right.
but I think the bigger issue is that for me, it's like Bitcoin, there's so much leverage. And that's not Bitcoin, that's paper Bitcoin.
Right.
There is a paper gold market. It's just that the market for Bitcoin may be mostly paper, right? And so the idea is that, you know, where a lot of people look to hold physical gold, banks do, et cetera, there's not as much in terms of Bitcoin. And so the idea is that the fallback, this liquidity starts to fall back, the volatility really starts to pick up in Bitcoin, much more so than gold. And so it's not the waves themselves. They might have correlation with gold, but the idea is the amplitude of those waves up and down are just increased just because we're talking about the paper market for Bitcoin being the primary driver. The tail is wagging the dog. And so to me, it's hard to think of Bitcoin in the same class as gold because of that potential volatility.
So you have this chart of the relationship between Bitcoin and liquidity, and then you have gold. And the question is, okay, what happened here? What happened in 2023, 2024 that spurred this monstrous move to the upside in gold bullion? And, you know, it can be any number of arguments. It can be in the wake of the gilt crisis. It can be that there was a point of no return with U.S. debt. It can just be, you can blame Trump if you want. You know, you can say that the central banks around the globe just decided now is the time. It can be the BRICS argument that we've seen, but it has certainly become the debasement trade, if you will, against the ongoing decline of paper currencies around the globe.
Well, I think for the rallying gold this year, you do have to blame Trump if that's the word, because look, I mean, We talked about putting they're talking about putting tariffs on gold.
Mhm.
And so I look at the early rally this year, anticipating tariffs. And so we got to adjust it. And what did that do? That led to a massive influx of gold into the United States, right? Repatriation, and so much so it affected GDP. And so Atlanta Fed's giving you GDP with gold and without gold because we're running a trade surplus versus a deficit. It affected it that much. And then we realized, oh, wait, we're not tariffing gold. And now all of a sudden we announced the tariffs on foreign countries. And what's happening? I mean, if we're saying we want to repatriate manufacturing to the United States, we repatriated a ton of gold. Now we want to repatriate manufacturing. In essence, we're saying the dollar will no longer be the reserve currency because it's maintained through trade deficits.
Right.
And so the rally here is likely, foreign governments, foreign central banks having to sell our treasuries, sell dollars. And I think some of that's finding its way into gold, because what's going to be the reserve currency once we say we're going to balance out our trade deficits with other countries, which will probably never happen, but to a lesser degree or to a greater degree will be more balanced. Well, it just means there's going to be fewer dollars floating around the world. And where's that money going to go? I think naturally right now it's going to gold.
Don knows the answer to that. It's ammunition, right? Isn't that going to be the
gold ammunition, not brass?
So
those heavy bullets, you're gonna have to guess. It's gonna have a nice little arc.
JW Bullet asking, with the focus on hard assets, gold and silver, are we looking at a bull crash where inflation takes off and no one wants to buy U.S. debt?
Well, here's the problem with that, though, right? Is that you buying U.S. debt, we're saying you don't want to hold dollars, right? So, I mean, is it to China's advantage to say we're going to liquidate 1.5 or $1 to $1.5 trillion right away and crash the dollar? No. I mean, you just had a tremendous loss of value. I mean, Russia was able to, because they had much fewer holdings of dollars because we didn't trade as much with Russia. So they could divest themselves of dollars, but these countries are not going to be able to quickly divest themselves of dollars. They're going to have to do something with it to generate yield. It's going to flow into treasuries to some degree. And right now we have the highest rates of most every developed country in the world, right? So why not hold it? But on the margin, though, if you're China, you may have to defend your currency because, look, I mean, they are not in good economic position right now. I mean, things are really slacking in China big time. So much so we're hearing they're paying the tariffs themselves, right? They have the production side of, my brother's experiencing it with people he consults. I mean, it is a big deal. I mean, manufacturing in China is down big. So they may have to defend their currency because it's going to collapse. So that means they're going to sell dollars and buy Chinese yuan.
Mm-hmm.
And so if you're talking the biggest threat to the treasury market and to the dollar from my perspective is if foreign countries, if we see a major downturn, they may have to defend their currency to strengthen it rather than saying, hey, we don't want the dollar and we're going to weaken it. And so we saw that, a number of years ago when China sold about $500 billion to support the yuan literally within weeks. It was a huge deal because their economy was struggling. Their currency was collapsing. They had to create a stopgap measure. To me, short run, that's the biggest threat.
Well, and how many governments do you ever see that go from deflation to hyperinflation in 2 years? That is a tenable situation to be in for China.
Yeah.
So,
Blake, question for you.
Yeah.
Today I got a question from somebody. They said, well, why is coffee down 7.5%? And I said, well, because coffee is up 40% in like 3.5 weeks. I mean, that's the reason why it's down. So now you look at gold, right? So we've had this move to 3,700 and you've seen this just very smooth momentum the whole year. Is there any major catalyst that would potentially take gold back down to 3,200, 3,000, or silver back down to that 35 level after the runs that we've seen?
I have no idea if there's anything that could do it because you're talking gold quoted in US dollars.
Mm-hmm.
So you'd have to have could gold fall compared to other currencies? Could we see a flight to other safety? Sure. But the dollar could trade in the same low range for months and we'd be fine. The dollar's fine. I shouldn't say it. The world is fine, but we're fine. But gold pulling back to that level would require a rate hike. I mean, that's the only thing I can see it. There has to be an increased sentiment that we are fighting inflation faster, that we're seeing disinflation. So, I mean, maybe a complete recessionary collapse in demand.
That's what I was going to go with.
Yeah,
I
recessionary
mean,
collapse in demand could do it.
There's a massive amount of foreign debt that's denominated in dollars. So in Europe,
Right.
they may borrow money, but they've got to repay it in dollars. So if we start to see a credit contraction, right, a crisis, financial crisis, I mean, that's ultimately the pathway for dollar strengthening. Is the pool of liquidity has to drain all of those dollars that we put in the system. All of a sudden, if that starts to get written off here and abroad, debt has to be repaid in dollars. That's where that demand's going to come from. And if we shrink the supply of dollars because we're imploding the credit, we're writing off the debt, we're defaulting individually or corporates or whatever internationally. That's where the dollar strengthens, right? And that's the recessionary situation, because the dollar still is the reserve currency, and so you should see strength in that circumstance. But it's gonna take we're gonna have to see some pretty significant switch here in terms of weakness economically, globally.
Well, and you could leave. Yeah, I was going to say, you could leave and say, let's not even limit it to a U.S. recession. It could be everybody but the U.S., and that would also create the same kind of situation.
Yeah. So you could have a crisis in Europe, for example, and there's going to be a scramble for dollars. Now, does the Fed engage in currency swaps where they print dollars and exchange it for euros to give them dollars to ease the money, ease the credit conditions and the supply of dollars that they've done in the past? I mean, so there's ways they can kind of smooth it out. But again, we will at some point where all of a sudden we're digging a hole faster than the Fed can fill, because we're just seeing defaults really picking up, right? And the credit in the system starts to contract. That's where the dollar strengthens. And that's where gold goes down 30%. That's what happened in the financial crisis. Once the Fed went to ZERP, engaged in QE, gold found a bottom like in October, and we're off to the races again.
Tim asking in the chat about the concept of what if the 30-year yield were to go to 6%. And just to briefly point that out, I mean, basically that's a huge treasury supply against demand imbalance. Basically, investors are going to want more yield. Inflation premiums would return. Term premium is being replaced. There's a massive impact on the economy at that level. You're going to be looking at what, like 9% on a mortgage at that rate?
Yeah, you always add at least 2%.
Okay.
But in the most extreme markets, when the lending's not there, you go 2.5 to 3% over the 10-year.
And
So
regional banks
30-year,
killed on that too.
Yeah.
Well, then you get people that were in the 70s say, well, we had a 15% mortgage.
Right.
Yeah, but you bought your home for 1 times your income in a year.
Right.
Yeah.
Right. So I mean, at the end of the day, a 6% rate on the 10-year would be very catastrophic, not just for borrowing costs for the government, right? We're going to talk about massive deficits, or you're going to have to massively cut spending, which will lower GDP. And then the carry-on effect, like I said, a 9% mortgage, who can afford it? I mean, right now you're seeing existing homes trading at a premium to new homes. Why? Nobody wants to sell their home, right? Because they don't want to incur that higher interest cost to buy a new one and take out a mortgage. It's just going to exacerbate the situation. So I don't think the market can handle a 6% rate, right? Economically, we cannot handle this. We see a major contraction in the amount of money we're spending, but we're servicing $37 trillion in debt. So, I mean, again, that you can kind of see the idea that developing here for yield curve control. The Treasury right now is borrowing extra money every quarter so they can have cash. So if something happens, they can go and buy back debt, right? It's not QE, because that debt's, they're buying it back and it's gone, right?
But they didn't refinance or buy it back when they had the shot. That's part of the problem. They dropped prices, the yields fell dramatically. We had, the spike in bond price and yields fell, and they did not take advantage of the opportunity to refinance our debt. We just left it at high prices.
Yeah.
Which
I mean,
puts us at the default level.
Trump's first term, he did extend that duration. They did try to sell more treasuries out there, but the trend, Bush, for example, I mean, the average maturity was like what, 2.5 years, just we're rolling it over. And obviously in Yellen under the Biden administration, they put us in a very big pickle, because the short term, Garrett's talked about a lot. They pumped a ton of money into T-bills to goose the economy. But at the end of the day, we did not take advantage of lower rates. We just,
Right. Right. So we've got about 13 minutes left. We're looking at this chart right now. S&P 500, basically, nothing happens, right? Big pop, big drop, big rally, and now we're right back where we started. And the New York Times coming out saying takeaways from the Fed meeting. Yes, sometimes the best takeaways from the Fed meeting are the friends we made along the way. What is your takeaway, Blake, from all of this? Because to me, a day like today, it's to live inside the charts, live within the deviation bands, and we've seen a pretty sizable delivery on that 6:55 call at 3:00 today. What are you taking away from an event like today?
I just took away that we overpriced in the future expectations, and the market is saying, okay, so we were priced right. We should have been priced right at this level. This is the expectation. This is where we're at. So we overpriced it in. We beat up the dollar right down to its main floor. The S&P is coiled back in the middle. So I think we've reacted. We overpriced it. We relaxed and said, okay, so where are we at? I think we're we're going good with the next 3 months. I think we can go with whatever trends we're going to really set up through December, through the end of the year. And it could be dollar stabilization. It could be a very flat S&P. This last quarter could be a dud. I kind of think that's the case. And
you, Brandon?
Sorry, I was responding to somebody in the chat. What was the question?
Basically,
I think I should heard everything, but just in case.
The joke again?
Now I'm trying to correct what I wrote because I typed the wrong word. All
right. Core takeaway on a day like today with the price action that we see on this afternoon and the way that things have operated today.
Frequently, today does not perfectly reflect where we're going to be a week from today. And so don't read so much into it. I think Don's comments earlier about the VIX not rising a lot, it just says that in general, institutions are generally delta comfortable. And that means the market can rally too. It's not a one-sided scenario. It's just a matter of that we saw some sell side pressure. Yes, we weren't super correlated, but it's not like we're panic buying the VIX, right? The VIX even declined at one point. So just realize that don't expect there's going to be a lot of directional just bias based on today, but we will have a better read a week from today. We may see a rally the next couple of days. We could see a sell-off the next couple of days, and we could be entirely different next week. So I think today, just recognize there's potential for volatility here, though.
Definitely want to react. This is the thing that we were pointing to, 255 to the, what is this? What number is this? Where are we? There we go. 655 call, $1.60 to 550, 25 minutes. That's this, outside the deviation lines, outside the Bollinger Band reversion. And that's what I'm trying to find on days like today. And hopefully we have a lot more of this, because we start getting into 1.5%, 2% days, then you can get a little bit more active, and then you can live within the lines rather than trying to predict where things are going to be 2 to 3 weeks from now. I think it could be very, very difficult. Is there anything, if you look at your ghost prints right now that might have popped up that we hadn't seen before this meeting? Anything significant that might be
knowing from my perspective, it's like leading into this, I really felt that what the option market was saying is we're expecting volatility. And we got it. Yes, we ended up unched or somewhere around unched, but we got volatility today. We saw the buildup in the VIX. So I really wasn't trying to key off anything specifically today, earlier before the Fed announcement, just because everything can change, right? So I'm curious to see, and after the announcement, what's really materialized. I haven't had a chance to look yet. So, but and in the coming days, where's the flows going? Are we going towards the inflationary side, or are we going towards the deflationary side? Market up, market down. We'll see.
Well, I look at this and I just say, all right, well, we're going to get up. We're going to trade the next day. We'll go from there. Blake, as far as you're coming out of the 10% group, what are your expectations? What are you looking for right now as we move past this day, particularly as we head toward Third Friday?
Well, that's the great thing about the 10%, everything is based off the volatility of the previous session that we've already looked at. So we're just going to be dealing with a probably half range tomorrow, because I don't expect tomorrow to repeat this level of volatility, certainly. So we'll probably be trading half range tomorrow. And it's what's great about the 10% is we have targets, we have levels. And the funny thing is, even with the volatility, it hit top, it hit bottom, it hit top, it hit bottom over and over again, and it defended those levels. So even with surprise economic, the market loves math. I always say it's amazing how magical math is. It's just math, but it is magical, and it's pretty cool to see it predict and line up so well, even on a day like today. So we just deal with what the chart gives us. We deal with the volatility that it gives us. So tomorrow we'll be dealing with probably too wide of a range. So we'll do half the range likely. I'll have to run the numbers here in 2 hours, and then I'll know. I'll know my numbers in 2 hours. So,
but I can share the console. So I just filtered for large block trades, so I can take control and just show you really fast while we have it up. But see, I can't share.
I do want to give Blake one thing before we go, but yeah,
Sure.
Please feel free. You want me to take it real quick?
it says that you're the co-host, Brandon. I don't know why it's not letting you share.
Yeah.
Well, just real quick.
Maybe expand it. Yeah, there we go. Sorry, I just need to make the window bigger.
You got it.
They couldn't make the button smaller, could they? Let me just slide this over and share. So if we're just kind of taking a look. So what I've done here is I've basically looked for stuff that's being bought. I'm looking for at least 3,000 volume when it triggered the alert, and I'm looking for a high volume relative to open interest. So at least 2. And so we're trying to isolate as large block trades. When I block trades over 1,000 contracts, and then over to the right-hand side, we can see kind of the time that it was traded here in Eastern time. So, and I'm going to just kind of highlight the ETFs here for just a moment. And I can't do a secondary here, but as we look at the ETFs and we scroll back to the right, I mean, what do we see here, right? So we're kind of just looking generally. We got IYR calls at the ask. And we can look over to the right and say, okay, well, what time is that placed? That was earlier, right? So we can kind of look at what was placed later, and then look at size. We got puts here. This was the September 30 puts being bought at the ask, 22,000 contracts, 8,800 open interest. Again, when was that filled in the queues? And we look off to the right. That was 1:06 p.m. Eastern. Again, that's pre-Fed, right? So they announced at 2 o'clock. So again, we can kind of go through silver here. Puts being bought as a spread at the ask. And again, we scroll over here. When was that traded? This is all kind of pre-announcement there. When I saw a little bit here, 37,000 contracts traded. That was probably in one print. Buying the 71 calls. We talked about KRE earlier. And let me just move that to the top so I can get the time right. And that was traded 226. So that was after the Fed statement, as the market was kind of going back and forth a little bit before Powell began to speak, about 4 minutes before. Again, you're seeing 71 calls being bought. And if we're looking at, right now, well, what's leading the market right now? It's financials. So at least, the takeaway right now, I mean, seeing sizable trade, and maybe we're backing off it a little bit in KRE, but right after the Fed announcement, before Powell began to speak, you did see some trade coming into, that would have been about 12:26 in here, right? So a little bit of a spike right here, and then we started to roll back over again. But again, probably more of a buy side bias right now. Just taking a quick stab at what we're seeing here, just on the ETFs, that we're seeing some block trades in, small caps and puts being traded. But again, we'd probably want to focus on stuff post Fed to get more reaction there. But KRE, we got the Qs, IWMs. These were traded after as well, after Powell came off. And this was a spread trade here, buying puts, buying the 234, selling the 228. You see the spread tag over there. Anyway, so a little synopsis anyway. Probably a little more time we got to cover it, but.
Well, I wanted to give Blake a real quick shout out for his math comment right there. There you go. More you know.
Did you know?
All right, we got 4 minutes left, and I take a look and see if there were any additional questions in the chat. As always, looking for opportunities, people asking questions about I could not trade the VIX after 416. I don't know what to tell you about that, my friend. I apologize for that. As far as anything else goes, tomorrow we have FedEx reporting earnings, and obviously a very important bellwether for global markets, global economy. Anything that you're anticipating there?
I think that's back to stagflation. I think you're going to see lower demand. I'd actually want to fade FedEx and fade Amazon and fade, if the consumer is going to get squoze, squeezed, squashed,
Squozed,
squozed,
Wish.
then squashed. Yeah, I think that's what I'd be. Whether we're seeing it yet, that's the question. So I think watch for guidance is what I'd be saying.
Okay, Brandon, anything on FedEx for you?
Yeah, again, it's like you can try to guess ahead of time, or you can wait for the announcement to occur. But like what Blake's setting up here is saying, look, if you're doing earnings, flip on it. You're probably gonna go bearish, right? And so,
Could
or
be.
you can wait. That's right. Winking a nod here, right? But otherwise, you wait for it to happen, and then you make the determination. So, I mean, if FedEx announces and they beat estimates, revenue, earnings, they raise their guidance, and the stock price reacts positively, I mean, that could be a long trade. Now, is that a long shot that's going to happen given what we're seeing? Probably so. So again, if you're going to take a bet on the earnings, I'm with Blake. I think you take the downside.
Last time that they talked, they said we see no additional adverse economic, geopolitical, or international trade-related developments. Now, that's obviously a pretty standard thing to say, and talks about how sensitive their outlook. Has anything, in your view, changed about the global economy and global markets in the last 3 months that could drastically impact that type of outlook?
I mean, anecdotally, you're hearing that global post offices are closing, right? Because there's nothing they're shipping. I had to ship something to Taiwan. My wife and I there was like, maybe like $100 of value to my son. And they're saying, you're going to pay $50 in tariffs, right? In Taiwan, my son's going to have to pay it before he can accept delivery. Turned out not to be accurate. He was able to get it, but there's just a lot of confusion. I have a little Land Rover emblem that's being shipped for Malaysia. Says I'm going to have to pay an import duty on that. And again, you got to pay it to DHL, whoever's delivering it. And so the idea is that I don't know how much it's going to be. Nobody can tell me. And so, again, the post office can't get it right. They don't know, again, there is a lot of confusion. Again, we are seeing, I believe we're seeing a contraction in the amount of goods that are really being shipped. It's not affecting Pinduoduo, apparently. That stock's performed relatively well because Temu, we got rid of the de minimis exception. So, look, all I know is there's confusion, right? I don't think anybody has a good read on it. Okay. I don't see how that's positive.
All right, everybody. Well, it is 4:00. Blake, I'm going to give you the last word. Anything prophetic?
You know what? I would just say that what do we as consumers like? We like to ramp up our credit cards. We like our cars, and we like to do it on the back of our mortgages. We're not refinancing, so we're not getting free cash. Cars are being turned in left and right. Cars are being sold and downgraded. So they're selling their $70,000 car and buying $30,000 cars. And the car dealerships are at record inventories at higher rate flooring lines. So I think those are all signs that, again, the squeeze is on. So just be careful.
Very good. All right, everybody, 4:00. I want to thank everybody for taking the time to join us today. 2 hours go very, very quickly when it comes to the Federal Reserve and monetary policy and economic analysis. I want to thank everybody again. We will be back tomorrow starting at 8:45. Gentlemen, want to thank you both for your time.
Yeah.
Thank you.
Well, I think, Blake, you're going live with 10% tomorrow too, aren't you?
Yeah. We do every morning.
No, I mean,
right,
in the main room.
Yeah.
Yep.
What do you got? Give us a little taste.
We'll be showing some of the key levels, and we'll be able to show you some very current examples. So we'll share that in the morning or tomorrow afternoon. So
all right, everybody. We'll have a great day. We will see you tomorrow.
Thanks.
Take care.